Good morning. Fun and games. FOMC always brings a lot of volatility, and stock markets overpriced, are coming off, but nice little spike here in gold half an hour ago as the market reopened. Some move is like $50 jump. Pretty heavy stuff. What I want to go through with you guys though is obviously news. Yesterday the Kiwi unemployment is strong, and then this morning the Fed raised rates, and then there was a lot of chatter, and it's that chatter that I sort of want to go through with you. So if we come over to Forex Live, they summarise it nicely, how Jerome Powell highlights. So the support for raising rates was strong. A pause was not decided at this meeting, so that's still open as to what's happening in June. But policymakers believe they are close to the end of it. Inflation hasn't moved much, so cutting rates is not appropriate, as it'll take time for inflation to come down, and we discussed that yesterday. I showed you a chart of where inflation is in terms of the interest rate cycle. If you haven't seen it or don't know what I'm talking about, go back to yesterday's video. Credit tightening is a focus, and it's as it affects the assessment of whether the policy stance is sufficiently restrictive. Now, I discussed this yesterday, is that the credit tightening and the banking sector crashing is having an effect, will have an effect on what the Fed does, because that credit tightening is effectively like a rate hike, in that excuse me, in that banks won't be lending money out, so that's effectively like a rate hike. Corporate margins are expected to come down. A recession is likely, right? And they hope it will be mild. Hope. I hate the word hope. Hope is giving responsibility to someone else, whether it be a religious figure or otherwise. Hope is a useless invention. Anyway, labour market will obviously going to be cooling. The labour market is very tight. Inflation is still well above the goal. Current policy stance is restrictive and not far from the right level, so there might be some more rises. Reading between the lines there is that there might be some more rises, but they're not far from it. Real rates are around 2%. They aims to reach a restrictive stance to bring down inflation, and credit tightening complicates the assessment, adds uncertainty. Again, that goes back to banks getting smacked. And on banks getting smacked, I just want to highlight what I saw here is like RBNZ over in New Zealand saying their economy has strength and banks are well positioned. I haven't seen rhetoric like that since 2008, where you've got central figures in an economy, even on a global stage, saying it, calm down, everything's fine, we're all good. It does bring back memories of 2008, 2009, when they were saying the same thing, and it obviously and clearly wasn't. So that I thought was interesting. Again, here's more issues on banks. PacWest is considering strategic options, another bank that's gone down, and we'll go through Tyler Durden's readings and show you that that banking system. SEC, that's the Securities Commission in the US, is not considering banning short selling over bank soundness. Continue to short sell banks. And they know that. Right, so over to Tyler. Let's see what he's got to say. Regional banks puked after Powell said banking system's all fine. Yeah, right. VIX is up, Treasury yields tumbled, as they were on the rhetoric of we may be getting close to the top. 2 years has been flip-flopping around this 4% for months now. Dollar dived, Bitcoin chopped, gold rallied, and then we saw the spike after the close. Crude oil was smashed. Market is more dovish than the Fed. And this is the one I wanted to show you. 2023 bank failures are now larger than 2008 and 9 combined. So that value is larger than all of that combined. And as we can see, deposit outflows continue from large and small banks as people are pulling their cash. So not looking good for the banking system, and market risk, or markets for risk assets, i.e. stocks, are too complacent. Yeah, so things are starting to get a bit more real now, and that's why I see gold rallying, and I would expect gold to probably continue well into, you know, that's all-time highs right there. Yeah, that's not going to last. I think gold's going to probably heading up towards 5,000 as this starts to get a little bit more messy. Looking at other prices whilst we're here on the charts, we're seeing bonds, 10-year bonds, have come off on the back of FOMC. You know, the rhetoric that, hey, it's you know, we're getting close to the top. So if that is the case, we can see that, you know, 10 years are under the 2 years, so that screams recession already, right? The 2 years are trading at around 4%, and 10 years at 3.3. You've got short-term rates a lot higher than long-term rates, which would suggest that there is a recession coming. In fact, Tyler Durden notes that it's 94% chance that it's happening in the next 3 months. So that's the bond market. Gold having fun, as I mentioned, heading higher. VIX, which is the protection or the fear index, obviously spiking as stocks get smashed. Bit of a support there, but I don't expect that to hold. It might come and backfill that the news announcement and then sell off. So maybe a 60-point rally before fading again, if it's lucky. Dollar index. Nobody wants to own US assets as the banking crisis continues to develop. Everybody's pulling the money out of the US, and by the look of it, putting into Japan. Yen getting stronger, which would piss the BOJ off, no doubt. The pound and the euro benefited off the back of the Fed, and also the ECB was last night too, wasn't it? They raised rates, kind of in the shadow of US, but yeah, oh no, that's tonight, looking to raise rates, so that'll be interesting to see how the euro performs. But yeah, I expect we've been targeting this 112 for some time now, and it's still on its way there, which is good. And Aussie dollar is still weak, as you'd expect. Even though the US dollar is weak itself, the Aussie dollar is just a basket case and should remain so, as I don't see any reason to own Aussie assets, particularly when commodities are getting smashed. Iron ore, coal, you know, our two biggest sellers. Oil, not that we sell oil, but that's natural gas, which is also weaker, and copper is also weaker. So all the commodities, look at the commodity index here on Bloomberg commodity index is getting smashed. So that ain't any reason to buy Aussie. I'm going to be selling it. And on that note, guys, I shall see you tomorrow. Have fun. There's still a bit of data to deal with the week ahead. ECB tonight and non-farm payrolls tomorrow. So stay cautious.